Credit card defaults in the US have just hit their highest level since the 2008 financial crisis. And if you remember what happened back then, it wasn't pretty. Banks failed, jobs disappeared overnight, and millions of families lost their homes. It was chaos. Now, here we are again, with consumer debt skyrocketing and the cost of living making it nearly impossible for people to get by. The big question is, are we heading toward another financial disaster, or is there still time to turn things around? Before we continue, please consider subscribing to the channel, as it really helps a small channel like ours go a long way. The cost of living is rising faster than people can keep up. Rents are climbing, grocery bills are through the roof, taxes on property, insurances, and anything else are rising. Meanwhile, income levels are lagging far behind. For most people, there's simply not enough money to cover everything. What makes matters worse is that the help that people received during the pandemic through relief packages and cutbacks on expenditures during lockdowns don't exist anymore. That cushion is long gone, and many are using their credit cards just to survive. It is like using a spoon to escape a sinkhole. Americans are now believed to owe a staggering $1 trillion in total as loans. That's a record, and not the kind you celebrate. Combine this with interest rates hovering around 15 to 20%, and you've got a perfect storm for financial disaster. Even if you're paying the minimum on your credit card, the interest is piling up faster than you can blink. How did we even manage to get to $1 trillion? Well, during the pandemic, credit card issuers went on a shopping spree, recruiting customers who perhaps would not have qualified in the past. People looked like safe bets because their bank accounts were temporarily flush with cash from stimulus payments. But guess what? That money wasn't permanent, and now those same lenders are seeing massive delinquencies. Let's put some numbers behind this mess. In the first 9 months of the year 2024, the credit card lenders had to write off $46 billion worth of unpaid loans. This is a 50% increase from last year. This is the highest level in the past 14 years. It's like the complete GDP of some small country suddenly went missing. These write-offs occur when the lenders have given up hope that the amount loaned will be returned by a certain borrower. They're a key measure of financial distress, and right now, they're flashing red. Inflation has been relentless, and the Federal Reserve's response of raising interest rates has only added to the pain. The idea was simply to diminish the chances of inflation by increasing the cost of borrowing, but this too has its consequences. Sure, it might cool off price hikes, but it also makes credit card debt way harder to manage. Now consider that if you are carrying a balance on a card with a 20% interest rate, you are effectively making the problem worse each month. Now imagine this scenario with low-income households that are already really a single paycheck away from losing everything. While the higher-income households are still surviving, the bottom third earners are tapped out. Their savings rate is essentially non-existent. And let's be real, this is not merely an issue of lower-income people, as the middle class too is under stress. Basic necessities like shelter, food, and transport, among others, are now taking a huge chunk of the family's monthly income. Here's where it gets even more frustrating. Officially, the US isn't in a recession, but for the average American, it sure feels like one. The government is playing with numbers to make the economy look better than it is, but the reality on the ground tells a different story. People are struggling to afford basics, let alone save for the future. If saying it's a mess was not enough, some American states have even pushed for radical labor reforms that would increase the amount of unskilled workers in America, starting a new era of inflation. While this would benefit businesses, it would wreak havoc for the average American worker. It's a vicious cycle, and one that doesn't seem to have a clear end. This sounds bad now, but the bankers are already getting ready for worse days. Reports state that JP Morgan Chase and Citigroup have been writing off a huge percentage of their credit card loans recently. The annualized rate of write-offs has been reported to reach 6.1%, which is a pretty big jump from last year's 5.2%. And that trend isn't slowing down. These numbers are more than just statistics, they're a warning sign. If delinquencies keep rising, it could lead to even tighter credit conditions, making it harder for everyone to borrow money. That includes businesses, which could slow down the economy even further. All this talk about defaults and late payments must ring a bell, because it has happened before. The entire world was shaken during the financial crisis of 2008. It taught us one brutal truth: debt can be a time bomb just waiting to explode. With the passing of the time, the trigger was housing market. Due to handing out mortgages left and right, banks quickly found themselves in a risky situation where mortgagors could not pay back their debt. Now the focus has shifted to the credit card users, but the issue remains the same. People are still in tremendous debt and have no way of paying it back. In the year of 2008, the US recorded over $600 billion in American subprime mortgages, which then led to an economic crisis. At its peak, the mortgage delinquency rate hit 11.5%. By comparison, today's credit card delinquency rate is climbing steadily and sits near 6.1% as of late 2024, according to major banks like JP Morgan and Citigroup. Even though it may come off as an overall reduction, the two differ in nature entirely. You see, credit cards don't come attached with appreciating assets like houses or bonds. Credit card debt is pure liability. The consumer gets no tangible return, only a growing interest burden. In 2008, the balance of U.S. consumer credit card debt was around $973 million, while the figure today is $1.03 trillion, which seem close on first glance. But there is one substantial difference between the two figures. During the 2008 crisis, total household debt was around $10 trillion, but mortgages made up the lion's share. Today, credit card debt alone accounts for a massive portion of overall consumer debt, with interest rates that are far higher than mortgage rates ever were. Some cards now carry annual percentage rates, APRs, exceeding 25%, compared to the 5 to 6% seen on many subprime mortgages in 2008. The most prominent change from the events in 2008 is the absence of a financial buffer which would enable the consumer to retain their spending power. In the years leading up to the housing crash, the prices of homes reached an all-time high, which allowed the consumers to tap this equity in case of an emergency, meaning they had a line of credit. Such assistance does not exist today. Rather, the majority of lower middle-class families have completely used their reserves. Another factor that complicates this scenario is inflation. In 2008, inflation was quite low, which enabled the central banks to cut the rates economically without fear. On the other hand, current high levels of inflation have compelled the Federal Reserve to maintain a tight monetary policy, which is putting further pressure on consumers. If defaults continue to rise, the ripple effects could spread beyond consumers. Banks are already writing off billions in unpaid loans, $46 billion in the first 9 months of 2024, up 50% year over year. Should this trend persist, it could tighten credit availability, impact lending markets, and slow economic growth, creating a feedback loop reminiscent of the Great Recession. The crisis also taught us about systemic risk, the idea that when one segment of an economy falls, the rest goes down with it too. In 2008, it was the housing sector that led to this crisis, but it is the consumer credit market that is the center stage today. The takeaway is this: to forget the lessons of past is to invite another crisis. The fact that a significant number of credit cards are being defaulted is no longer just a financial issue only, but a major concern as it raises more questions than it solves. The purchasing power is not keeping pace with the earnings, and a significant segment of the US society is getting cut off. If this trend continues, we can expect more profound effects on the economy, including stagnation and increased unemployment rates. So what do you think about this? Let us know in the comments section below, and make sure to like the video. Thanks for watching.